All right, it looks like most of you are here, so we'll probably get started. This is Rob, by the way. So first of all, thank you for joining Finance 101 webinar. I realize that there's probably lots of other better ways you could be spending your lunch, so we appreciate it. What we try to do today is pick some high-level topics that we thought would be helpful. We're going to try to keep it pretty quick, so under half an hour. And the main reason for that is A, so you guys can get back to your days. I know you're all busy, but also we wanted to leave a lot of time for questions. So we obviously pick some high-level topics, but we're not going to know what you really want to talk about or get answered until the end. So feel free to use that chat box to start typing questions, and at the end we'll start addressing them. So I just wanted to start first off by just telling you a little bit about who's running this webinar. So it's a co-sponsorship with Glen Eagle and alooola, and Glen Eagle is actually the parent company of alooola. So Glen Eagle handles about $4 billion in assets, and it caters more towards individuals or institutions that have established wealth. So they may be dealing with more complicated questions, whether that's estate planning or financial planning or just investing in markets. Whereas alooola, which is a sub-brand of Glen Eagle, that caters more towards individuals who are kind of actively growing their wealth and maybe going through different life stages. That could be marriage, that could be insurance, that could be buying a house, or just starting to grow their wealth in the market. So that's kind of the two differences. I work on both sides, but for purposes of this conversation, I do handle most of the investment discussions at alooola. And I'll just let some of the other members of the team here introduce themselves.
Hi, I'm Carol Ann, and as Rob said, thanks so much for joining. We're really excited to have you guys and hope that you find this information helpful. I handle the financial planning aspect of the firm, and we'll talk a little bit later in this presentation on exactly what financial planning is. But on a high-level view, it's supposed to help you with getting a broad picture of where you sit now and a roadmap to reach your goals. So that's mainly what I work on.
I'm Taylor. I work in the 401k department, focusing on employer-sponsored and individual retirement plans. I'm sure that most of you attending this webinar have either a 401k plan through your employer or some other type of retirement plan. So I work with individuals like yourself on a pretty much daily basis.
So as Rob mentioned, we just chose some topics based on what we hear from our clients that we thought would be of interest. And but as he said, we're leaving plenty of time at the end to cover any topics that maybe aren't included in our presentation in the first part that you joined the webinar because you wish to learn more about, and also to answer any questions. So there's a chat part in the webinar. Feel free to use that while we're talking. If it fits in on the topic that we're talking about, we'll try to answer it right then. But if not, we'll definitely get to it at the end of the presentation. So please don't be shy. I know it's hard to be interactive through a computer, but we really would appreciate if you guys, let us know what you're looking to get out of this. So the first topic we're going to be talking about, Taylor's going to take us a little bit through budgeting basics, what a budget is and how to stick to it. We often get the question with our clients of paying debt versus investing. So we're going to go through a little bit of that. And then on the investing side, why would you invest? How do you go about investing? And what are the different ways? And then towards the end, as I mentioned, we'll talk about financial planning and give you some takeaways that hopefully you can start implementing as soon as the webinar is over to help you in your finance understanding and journey. So with that, we'll have Taylor start by giving us just some of the budgeting basics that we have come to.
Okay, so to start, we'll go over some of these budgeting basics, and I'll let you kind of read through these first few steps on your own. We found that most people have attempted to start a budget at one point or another, but never really got around to finishing it. So you want to sit down and really figure out exactly how much you are spending each month. And this can be done by breaking down not only your credit card statements, but adding in any cash and check payments. By doing this, you can get a clearer picture of your monthly expenses. These expenses will then be broken down into two main parts, which are fixed versus variable expenses. Fixed expenses such as rent or car payments are the same each month and don't typically offer much room for adjustments. So with that being said, when creating a budget, you may want to focus on these variable expenses such as going out to eat or going to the movies. These expenses offer more flexibility, and if you're finding that you're spending too much on a certain month, you may want to pass up that 5-star restaurant and save a bit more that month. And of course, the hardest part is actually sticking to your budget. So we found that many people have trouble staying focused and motivated to stick to their budget. When our clients are running into these issues, we try to help by suggesting some simple changes, such as using cash instead of credit cards. Statistics do show that people tend to spend more money when they're using credit card payments than they would have if they made a cash purchase. We understand you can't always use cash. So if that is the case, you can set limits on your credit cards to avoid overspending and making sure you're staying within your budget. Creating habits like these will definitely help you stick to your budget each month.
Yeah, and I think one of the things that we found, particularly with a lot of our alooola clients, is employing kind of quirky habits that help you achieve your budget. Because I think everyone we talked to at some point has thought about making a budget and failed, or did make a budget and just hasn't been able to stick to it. So when you're trying to implement it, I think there's 2 habits that I'll just mention here that you may want to try. The first one is just writing out your budget goal, or whatever your goal. This applies to anything in life, but for this purpose, your budgeting goal, on a small piece of paper, and then taping it to the mirror that you brush your teeth in each morning. And the reason is because there's numerous academic studies that show that you're statistically more likely to actually accomplish that goal if you're seeing it every morning. And then the second one, which I think a lot of people forget about, but it is really important, is almost gamifying and rewarding yourself for your budget achievements. So a lot of people will often say, this month I want to save $100, and then next month I'll save $100, and then the next month I'll save $100. And it just becomes a little bit more monotonous, and you mentally kind of check out of the process. So what we often find people have a lot of success with their budgeting plans or paying down their debt or whatever it may be, is setting goals with explicit rewards. So if you save that $100 on the first month, maybe you get to treat yourself to 2 lattes at Starbucks. Or the next month, rather than focusing again on the $100, why don't you break down everywhere you shop and start focusing more on the discount retailers? So you kind of change the game, but at the same time, you're still focusing and staying engaged in your budgeting goals. So we created a single slide for credit cards, in part because we thought it tied in really well with the budgeting. And we get a lot of questions about credit cards, in addition to just kind of regular investment questions. So when we're talking about credit cards, we like to kind of categorize people into 2 areas. And this is something that you should do for yourself. It's almost like a self-realization activity, but either you're the type of person that spends on credit cards and just has trouble for whatever reason paying them back each month. And if you're in that category, then we really advocate that you don't spend as much on credit cards, or not at all. And the main reason is because, unlike other loans like mortgages or student loans, credit cards actually have interest rates anywhere between 15 and 35%, which is enormously high compared to other loans. So it becomes this self-fulfilling prophecy where if you can't pay it back, it becomes harder and harder to pay it back. So if you're in that category, if you're that type of person, 2 simple things you can do are: 1, you could call up your credit card company, and actually, Taylor alluded to this earlier, you can actually set limits. So you can say, I only want to be able to spend $800 or $1,000 or whatever it is. You can set that limit. So you are kind of self-restricting yourself from going over capacity. The second thing that we've had success with clients doing is most of our clients have multiple credit cards. So what you want to do is you want to write down the name and the interest rates that you're charged for each credit card. So you can say USA 15%, Bank of America 25%, whatever it is, and then take all of the cards except for one and put them in an envelope. And the only one that you should keep is the one with the lowest interest rate. So basically, you prevent yourself from physically being able to put anything on those cards, except in an emergency where you have that one card that has the lowest interest rate. The second category of people are the type of people that do have credit cards, they spend on them, but they usually have no problem paying them down. And if you're in the second category, we actually have the opposite advice, in which case we'd advocate that you put almost all of your expenses on credit cards, because the credit card industry has created this really expansive incentive program where now, unlike in the past, almost every good credit card gives you between 1% and 3% back on any cash spent. So you're really almost losing out on free cash if you're the type of person that can regularly pay it down and doesn't have to pay these high interest rates. The other thing that's on this slide, and I'll leave it up here just so you guys can kind of read the components, is credit scores. A lot of people don't understand credit scores or what goes into it, so we thought this was a helpful picture. But one thing we did want to kind of call out that a lot of people are always surprised to find out is that your credit score is actually dinged for the amount of times that it is pinged. And when I say pinged, what I mean there is every time that you apply for a loan, and that can be a mortgage, a student loan, or credit cards, in addition to many other things, your lender is legally allowed to then request your credit score. So the more times that your credit score is requested, the more impact it has, and it's a negative impact. So the reason I bring this up is because a lot of people, when they're applying for credit scores or mortgages, decide to apply to 10 different places and then see where they get accepted and then choose the best one. And you just want to keep in mind that actually it's probably best if you choose your top 2 or 3 and only apply to those, just because it then has kind of an insignificant effect on your credit score.
And just, piggybacking off of what Rob just said, if you're curious on what your credit score is, there are a lot of free things you can get online that will tell you your actual credit score. So if you're curious on where you align on that bottom chart, you can definitely figure out what it is. And the last thing that I wanted to say is a lot of people will pay off their credit card debt based on the one that has the highest balance. We actually suggest that you pay it off based on which credit card has the highest interest. So even if you have a credit card that has the highest interest, doesn't have the largest balance, pay that one off first so you can stop using it as much, because obviously it'll be less effective on your debt later if you're not using it. So with that, we just wanted to go to our next topic. We get asked by a lot of our clients, okay, I have credit card debt or I have student debt. Should I be investing or paying off my debt? And unfortunately, the dreaded answer is it depends. So it depends on a few factors. It depends emotionally on your personality, which we'll talk a little bit about. It depends on, what the interest rate of the debt versus what you could get by investing the money in the market is, and then what kind of debt you have. So just taking the one where we're looking mathematically on whether you should be investing or paying off the debt when comparing what you can get by the market rate versus interest rate, we would say that if the market is giving a high return, as it has the past few years, say it's giving you 12%, and your debt interest rate is 10%, then we would say you should put the money in the market so that you can get the higher rate of return in the market and pay off the debt faster. However, now with the market correcting, we're starting to see that the market rates are a little bit lower. So sometimes, only maybe around 5 or 7%, and your interest rate may be a lot higher than that. And in that case, we would say it might be smarter to pay off your debt rather than putting it in the market where you won't get as high of a market rate return. However, there is something to note here. If you have a personality where having debt really affects you and you can't sleep at night because it's stressing you out, then it really doesn't matter what the math says. In that case, we would say that you should pay off your debt because clearly it's affecting you and stressing you out. And so you kind of have to know your personality as well. And sometimes the math isn't always the answer.
Yeah, and I just want to add on what Caroline was saying is we put up this graphic because it gets the main takeaway. It kind of illustrates that in an effective way. But one thing to note is that all interest rates are not equal and all investments are not equal. So what I mean by that, just as an example, is under the new tax law, if you have a mortgage that's less than $700,000, those interest payments that you're making towards that mortgage are actually tax deductible. So it's not always, in that case, you may actually want to keep the mortgage even if the interest rates are a little bit higher than what you could get in the market because you get that added benefit of having it be tax deductible. Similarly, on the investment side, let's just say that you have debt interest rates that are slightly higher than what you think you could get in the market. You may still want to actually invest rather than pay down the debt as fast because in certain circumstances, if you're putting that money into retirement accounts, and when I say retirement accounts, I'm specifically talking about traditional IRAs and Roth IRAs. and we can talk about what those are and the differences at the end. But if you're putting money into those type of retirement accounts, the government actually restricts how much you're legally allowed to put in each year. So in 2019, it's $6,000. So if you decide to pay back your debt rather than invest in those two accounts, next year, if you want to then invest, you've lost the opportunity to put in an additional $6,000. So every year you don't invest those $6,000, you've lost that opportunity. So this is just a way of basically saying it's not, this illustration is helpful, but it doesn't say the whole picture. And that's why it's really important that whoever your advisor is, you talk to them and they kind of walk you through what the math is to figure out what's best for you.
Okay, so now let's assume that you've answered that last question and want to explore some investment options, but aren't exactly sure where to start. So many people wonder if they should be placing their money in investment vehicles or leaving it in the bank account. Depending on your personal preferences and goals, either could be an option. Of course, bank accounts are safer as they are government protected and have little to no risk. This FDIC insurance means that if the bank were to go under for some reason, the government would pay you back up to $250,000. However, banks do not offer the upside gains that investments provide by taking on some of that risk. So while from a risk perspective, leaving your money in a bank account sounds good, you do definitely want to keep in mind that you may actually be losing some money due to inflation. So this means that as the cost of living rises, the funds in your bank account are increasing at extremely low interest rates or not at all. So basically the same $100 sitting in your bank account that could buy you 20 lunches a few years ago may only be able to purchase 10 of those same lunches today. Whereas stock tends to do the opposite and has historically outpaced inflation. So with that being said, while investing in the market will allow for a much larger growth potential, we do suggest that clients keep at least 3 to 6 months of their monthly expenses in a bank account as an emergency fund. This allows immediate access to the funds when in need if you ran into unemployment or some other type of financial emergency, as well as the safety of that principal.
So now that we've talked a little bit about bank account versus investing, let's say that you are interested in investing, but what we hear a lot of times from our clients is, I just don't have enough money right now to invest. I want to wait a little while until I have more money available to be investing. And this is where we want to talk about compound interest, because we actually think this mindset can affect you if you're not taking compound interest into effect. So let's say you're 25 years old and you put in $200 a year, which means you're putting in less than $5 a week, and you just let it grow at a 5% market return, which is a pretty low market return for what we've had the past few years, but we're trying to be conservative in this example. At the age 65 of letting that grow, you'll end up with a little over $25,000 available to you. Now, let's say you do the same thing, but you wait 10 years before you start doing that. So now you're age 35 when you start investing, you still end up with a little over $14,000. So it's not that you don't have any money, but you are losing out in an amount of a little over $9,000 just by waiting that 10 years. So the point of this illustration is to say that even if it's a small amount of money that you have available because you do have some debt or you do have other things, we would suggest that you start investing that little amount into some type of investment and letting compound interest really work for you.
So now that we say, okay, we understand why it's important to invest, even if it's just a small amount, what are the actual ways to invest? So although there's lots of ways, there's mutual funds, there's ETFs, some other products that people might have heard of, we decided just to keep it simple by kind of breaking it down to the two most basic types of asset classes that you can invest in. And the first is stocks. And the way you can think about a stock is basically, if you own one share, one stock of Johnson & Johnson, you're literally buying ownership in that company. So although it may not feel like it, you are physically an owner of Johnson & Johnson. So just as an example, if you bought that one stock for $10 and Johnson & Johnson had a great year by selling lots of Band-Aids and Tylenols and other pharmaceuticals, and more people wanted to therefore own the company, maybe your stock price rose from $10 to $20 and you could sell that for all of the profit. Bonds on the reverse side, are actually not ownership. You can think about bonds as debt. So the way bonds work is, just sticking to the same illustration, if Johnson & Johnson is having an incredible year and they therefore want to expand by building another pharmaceutical building, they don't have enough money to do that. So they go out to you and say, hey, client, could you buy our bond for $10? And in 1 year, we'll pay you 25 cents. So in 1 year, you'll get back the $10 plus 25 cents in interest. So as you can tell, they're very different products. Bonds tend to be much more stable, and you end up earning a lot less, but you have less volatility. Whereas stocks can go up and down with the market, but over time, you tend to gain a lot more money. And you can see that in the hypothetical graph at the bottom of this chart. Now, the two things that you want to factor in when you're deciding, okay, I understand the differences, but which one or how should I allocate my funds, are your time horizon and your risk profile. So starting with risk profile, Carol kind of mentioned this earlier, but if you're the type of person that goes to bed and can't sleep because you know that your money might drop in the market, then you really don't want to allocate too much into stocks, because again, that volatility, they'll go up and down with the market. And if you, just as an example, had owned 100% bonds during the 2008 Great Recession, your portfolio would have dropped a lot less than everyone else's. However, on the reverse side, today, if you, even though your money would have dropped a lot if you owned a lot of stocks in the Great Recession, today you would have made a lot more money than the person who held on to bonds. So you just kind of have to know your risk profile. And then I just alluded kind of to the time horizon of if you had held on through the Great Recession with stocks. That's really important to consider too. If you're younger, let's say you're 20, 30, or 40, and you have multiple market cycles to go before you hit your retirement age, then you can afford to allocate more money into stocks, because even if the market does turn downward tomorrow, you have multiple market cycles to live through before you need that money. Whereas if, let's say, you're closer to your 60s or 70s and you're ready to take that money out, then you might want to allocate more towards fixed income products like bonds, so that if the market turns downward tomorrow, you're still okay and you have the money you worked so hard for. The second thing that we wanted to address here on investments is this idea of passive versus active investing. In part because it's been in the news a lot, and I think it's something that a lot of people get confused about. So the difference between passive and active investing is probably best illustrated with a simple example. So let's just say that you have $100 and you give me that $100 to invest, and I go out and I research all the top companies, and then I invest in the top 10. And then tomorrow I come into the office and I do the same thing, and maybe I take 2 of the companies we had invested in and I sell those and I buy 2 more. And every day I continually monitor and change and try to beat the market. That's called active investing. But because I'm putting in all that energy and that time, I'm going to take a little bit higher fee. So if you gave me $100 to start with, I might take one of those dollars and invest 99. Passive investing kind of has an opposite approach, where you might say, okay, I'll give you the $100 and I go out and I find 10 companies that I think are good and I invest in them, but then I leave the money alone. So if those 10 companies do really well, then your money rises. If they do really poorly, then it falls. But I'm not doing any active management. It's very passive. So as a result, I'm going to charge you less money. So if you gave me $100, I might charge you 25 cents and invest the rest. The important thing to note here is that studies argue which one's better during different market cycles. In our opinion, it's pretty much a wash. It depends on what you personally want. But you need to know that there's advisors that do passive investing and there's advisors that do active investing. And you kind of have to know which one's better for you. Just as an example, passive investing has been shown that it can be better because it's more cost effective, so there's less fees. Active investing, though, in down markets can sometimes be better because it protects you on the downside, because someone's actively putting in things to protect you from losing the entire market's loss. So there's really no, it's just a preference call, but you should be having those dialogues with whoever's managing your money or advising you, so you understand what they're doing.
So before Caroline gets into what a financial plan actually is, you should know that it's constantly changing based on your goals and desires. This is not a type of plan that is created and just set in stone. Budgeting is just one aspect of the full financial picture. As new events come up in your life, your plan can be adjusted and updated to fit your specific needs.
Yeah, so a financial plan is just really a roadmap. It's a way for you to get a picture of where you're sitting now and a step-by-step process of how to get where you want to go. So whether that's, hey, I want to know if I can retire at 65 when I want to retire, or I want to know if I can live to 100 and have enough money to do that, or things like I want to buy a house, I want to buy an engagement ring, I need to buy a car, whatever it is. It's a way to set those goals and then see where you sit right now, and if nothing changed, how long your money would last. But if everything was changed and you were to do the step-by-step process, how we can help you to reach those goals. So it's really just a way to give you an overall picture and personal guidance. As Taylor mentioned, it is only as good as the information you provide, and it also is very unique to your situation. So we couldn't give everyone on this webinar the same financial plan, because obviously there are varying ages and situations and incomes, et cetera, that would need to be taken into account. However, if you are interested in getting a financial plan, we actually offer a free one through our website that will help you with getting those step-by-step process and kind of seeing where you are, so you can have some peace of mind and just know. It's always better to know what your picture looks like rather than be in the dark and unsure. So with that, we want to give you some to-dos from what we just talked about. And I know we do have a number of questions, so we will answer those as soon as we finish up with this slide. But the first thing we would say is, make a simple budget. And actually through that financial plan we were just talking about that you can get on our website, it has a budgeting part. So we can help you with that. But Taylor did give some actionable steps if you want to attempt to do that on your own. The second thing we would say is figure out your debt interest rate. So with the debt, as we were talking about earlier in the session, it's important to know what the interest rates are so you know what debt to be paying off and in what order if you have multiple types. And then thirdly, we would say find help, whether that's with us or someone else, a close friend, a financial advisor Always ask for help and ask for some education. A lot of people will help you out for free if you just ask for it. And then fourthly, we would say create a timeline for your future investments. This is where the financial plan really comes in to play, because it will help you figure out what the next step is. There's been a lot of things we just talked about today, and there might be multiple different areas that you're interested in. So figuring out what steps you should take in what order is always helpful. So with that, I think we'll answer some of the questions that have come in during this session. And as we mentioned before, there is a chat. So if you are interested in something that was mentioned, or you have another topic you'd like us to touch on, we do have plenty of time, so feel free to send them to us. So our first question is saying that they're a 2 credit card person, and they pay it off every month, but they only actually have 1 credit card right now. Do we have any suggestions on the best credit card options for getting the cash back that we had talked about earlier?
Yeah, so this is a good question, and there's lots of different sites that do this. We are not credit card experts, so I just, we'll usually tell you what we're best at. This is probably not our best expertise of telling which card right now, because it changes a lot. However, I will say there's sites like NerdWallet, et cetera, that will list out what they view as the best credit card. I think this is just me personally speaking, and I'd be interested what the rest of the team thinks, but it really depends on your lifestyle. So, for example, I commute a lot. So most of my expenses come from, or a lot of them come from gas. So there's a particular card that won't give me cash back on anything, but when I spend on gas, it'll give me 3% back, which is great for my situation. I know there's other ones that give you higher cash back specifically on airlines and Ubers. So it really depends on what your lifestyle is, and then you pick the one that will give you the most cash back for those different segments of your expenses. I mean, there are cards that will also say across the board you get 1%, and those could be great too if you don't really have any expenses that are concentrated. But if you do, I would focus on the ones that give you particular benefits.
Great. And our next question is talking about student loans. I'm not sure the specifics, but with student loans, we definitely want to mention that if you have multiple student loans, make sure when you're making your monthly payments that they usually evenly are distributing that money to each of the student loans. You actually can call up and have them so the payment is going towards the student loan with the highest interest. first and then down the line. So the first thing we would say is make sure you outline your student loans and how much interest each one of them has, and then pay towards the one with the highest interest first. But if there was a specific, more specific question with that, feel free to just chat it so that I can make sure that I answer it correctly.
Sorry, one thing, I know we have a lot of questions, but one other thing I'll add to that is if you work for a government organization or a nonprofit, you actually might be eligible for government loan forgiveness. So to be clear, this only applies if you hold some government loans. But you could potentially get your loans forgiven if you continue working in that nonprofit or government agency. And the other thing is, even if you don't work for one of those types of institutions, if your income is not hitting a certain threshold, you may be eligible to reduce the amount that you have to pay each month because they'll tie it to your wage rather than what they request from the interest rate. So those are things, again, I know that I'm gonna move on because we have lots of questions, but if you do have an advisor, you should talk to them about that.
Well, and just one other thing, Rob, they actually clarified that they wanted to know if it's possible to consolidate student loans. I didn't know if you wanted to hit on that real quick.
Yes, so it's definitely possible to consolidate student loans, and it's something you should be considering. If you're going to consolidate, we generally recommend that you don't consolidate your government loans. And the reason behind that, so let's just say a lot of our clients have government loans and private loans. So let's say they paid for either their child or themselves to get through college. They took out government and private loans. We usually say consolidate the private loans, but try to keep your government loans. And the reason behind that is because I just mentioned earlier, two benefits that you get with the government loan is that they potentially could be forgiven depending on the institution you work for, and they potentially can reduce the amount that you owe each month. They're willing to work with you a little bit more. And if you have, let's just say you have a hardship, either unemployment or health issues, the government overwhelmingly is more willing to actually work with you, whereas private loans through banks, just because they're profit organizations, tend to be a little bit less flexible. So, don't consolidate the government loans until you've talked to someone to really make sure it's in your best interest. For the private loans, I think consolidating often makes sense.
And Taylor, I think the next question is probably more in your camp. It's asking whether the government restrictions and caps for how much you can save in a Roth or traditional IRA, is that restriction raised each time? And is it based on how many years you've been in the account, or is it just a set amount?
So to briefly kind of answer this one, as some of you may know, they did increase the maximum into your retirement accounts from 2018. It was $5,500 a year, and in 2019 it'll be $6,000 a year. So no, this is not raised each year. Every few years, the government will kind of take a look at the inflation and how much that has changed, and then based on that, they will decide if the maximum needs to be raised. And it does not have anything to do with how long you've had your account open. The maximums will stay the same, but one thing to note is there is what's called a catch-up contribution. After you're age 50 and above, you can add an additional $1,000. So for those people, the maximum will be $7,000.
And Rob, we have a question about the active versus passive that you talked about earlier. Do most investing firms have a mix of active and passive strategies / investment advisors, or should you be looking for a firm whose mission and values more closely align with either passive or active investing?
Yes, so I would say most major established investment firms can actually work with you to be active or passive. But at the end of the day, if someone, if you have a preference, you should talk to them about it. Just as an example, alooola tends to have a little bit more passive and therefore lower cost, because our goal is to kind of grow wealth over time and not beat the market, because a lot of our clients tend to be younger, so that's usually a better strategy. Where Glen Eagle tends to have a little bit more of an active component because some of our clients' wealth is more established, like I mentioned earlier. But yes, almost every major established financial firm should have both strategies.
Our next question is someone who is thinking of changing jobs and asking, can we help them with budgeting for a potential move? We can definitely help you with this. This is where the financial plan comes into play. There is a budgeting aspect of it, and so we'll help you with figuring out what your current budget is and then where you're trying to move to and whether your costs will be increasing and decreasing in different areas and just how you should go about making those changes. We can also talk to you about what you should be investing in to gain some money if you don't have that money right now to move, because obviously we would want to, in that case, put you in an account that's a little bit more liquid, so that you can have access for when you're ready to move and need that money to pay for either your rent or a house. The next question is asking about saving for college and the impact on taxes. Is there anything I can do to minimize my tax payments while saving for my kids' college? Taylor, do you want to hit a little bit on 529s?
Yeah, so this is actually a great question. We get questions like this all the time. There are a few different types of college education savings plans, but one of the most common is what's called, as Caroline mentioned, a 529 plan. A 529 plan is an account that allows people to invest specifically for future education expenses. Similar to, as we mentioned, IRAs and 401k plans help you save for retirement. These 529 plans were designed to help families save for their children's college. So there's definitely a few benefits to these. They're tax-free, so contributions grow free of federal and state taxes, meaning potentially bigger gains over time. And there's no taxes on qualified withdrawals. So what a qualified withdrawal is, and I'll kind of get into this, they're pretty flexible. It can be used for any qualified education expense, which is not only tuition, but also includes books, housing, meal plans, and things like that. And actually, with the new tax code, they updated these plans that they're not restricted to college saving now, and you can use up to $10,000 a year on K through 12 tuition for private schools and things like that. And they're pretty easy to open up. They have pretty low minimum contributions, and the maximums are high. And anyone can make contributions to these plans. So meaning grandparents, aunts, uncles, they can all help out, funding their loved ones' college expenses.
The next question is partially kind of repeating. It was, again, talking about someone who, I guess, is recently married and had a child. So one question was about the equivalent to the 529. So I think we addressed that. But another one that we had as the second part of that question was anything else they should be doing. I think we touched on this a little bit. I think the earlier you start investing, the better, even if it's a small amount, because you get that kind of miracle of compounding interest. But one other thing in this particular situation, I guess they just had a child. So definitely look into the 529, but also if you have a child, you should look into insurance. And that's something that you should make sure that you're shopping around to get the best price for you. Don't just go to one website. Because, as an example, companies are interested in just selling their insurance products. So you want to make sure you're talking to multiple people or getting some advisor to give you a list of multiple choices. But the reason behind this is just because at that point, you obviously are taking care of another individual, and you want to make sure that you're at least insured until they're an adult. And that's something, there's pretty cost-effective ways of doing that, which we can talk about if people are interested. They can type it into the dialogue and we can deep dive on the types of insurance you should look at. But that's just something that 529s and insurance are two areas you should definitely be thinking about if you're starting a family.
Yeah, and one other question we got is, how often should I be checking my credit score? This is not something that you should be checking all that often and be obsessing about. To be honest, it doesn't change that much. If you do, do something drastic that you think may have affected your credit score, or you've never checked it before, then it might be worth checking it out. But I wouldn't say to check it any more than once a year, if that. Really, it usually stays pretty stable if you're paying your credit on time, etc. So our next question is, how does marriage affect student loans, if in any way? I'm looking at marriage in the next couple of years, and me and my partner have a lot of student loans. Will the interest rate for those loans raise for him once we're married, or could they lower? And would a two-income household affect the loan consolidation at all?
Yeah, so just as full disclosure, the three of us are not the debt expert on the team. So we can actually, whoever, we're not going to name now, but if you'd like, we can have them talk to you. But from my understanding, if you are married and you're filing taxes jointly, then that affects your income, and therefore it will affect how much you could be asked to contribute back to your loan. So just as an example, if you had opted previously into the government reduced payment system, and then you get married and your partner has a higher income, then that could very well affect it. I have heard of people who take that into consideration when deciding whether to file jointly or separately. On the consolidation side, Again, I think it's possible, but that depends on who the consolidator is. So I know there's multiple vendors, and there's been clients who've applied and they have been asked that question of a joint income, and there's others that didn't ask it. So, again, I think it's that dreaded question of it depends, but I know for a fact that in some circumstances, the joint income could affect it.
And just to build on that, because it's a question that it depends, and we don't want to, obviously ask people to give us personal information over the webinar, feel free to call us or visit our website and chat with us, send us an email, and we'll be happy to go in more detail on any of these questions and give you specifics related to your situation. And also feel free to take advantage of that free financial plan, because that will help us with answering more of these questions. I think at this point, that's actually all the questions. We really appreciate everyone's interaction with us. And we do have a few more minutes, so we're going to stay on, but if you have any additional questions, but with that, we'll close it out for the main group. And we thank everyone for joining us today and really appreciate your participation. Thanks.
Thanks, guys.